The year is 1980. The price of silver doesn't just rise, it detonates. In a matter of months, it surges from under $10 to nearly $50. Trading floors across New York and London fall into a strange silence, the kind that only comes when something has moved too fast, too far. Phones ring unanswered. Brokers hesitate before speaking, because everyone in the room knows the same thing. This isn't normal. At the center of it all are two brothers, industrialists turned speculators, quietly accumulating massive amounts of silver. Not paper contracts, physical metal. They are betting on a simple idea, that silver, long ignored in the shadow of gold, is about to reclaim its place as real money. And for a brief moment, it looks like they're right. But then, almost overnight, the market snaps. Prices collapse, billions are wiped out. Fortunes vanish. Regulators step in. And a single question begins to echo, why did silver behave so differently from gold? This isn't just a story about two metals. It's a story about trust, scarcity, and the hidden mechanics of value itself. When investors ask, silver or gold, which is better? They're choosing between two fundamentally different financial systems. To understand that choice, you have to go back to the beginning. Gold emerges as money not by decree, but by consensus. Across civilizations, ancient Egypt, Rome, India, gold becomes a universal store of value because it is rare, durable, and impossible to counterfeit. Gold solves a fundamental economic problem. Trust over time. If you bury gold today and return in a century, it is unchanged. Silver begins in a similar role. For centuries, it circulates as everyday money. While gold handles large reserves, silver handles daily trade. But this dual system creates a tension. Gold represents stability, silver represents liquidity. As economies industrialize, that tension begins to shift. Silver isn't just money, it's a material. It conducts electricity, it reflects light. It's essential in photography, electronics, and medicine. This dual identity, part monetary asset, part industrial commodity, is both its greatest strength and its greatest vulnerability. Gold's price is driven by perception, fear, inflation, instability. Silver, however, is tied to the real economy and manufacturing cycles. Imagine two reservoirs. Gold is a closed system. Once mined, it rarely disappears. Nearly all gold ever extracted is still held somewhere. Silver is different. Much of it is consumed, used in electronics and scattered across billions of products, often never recovered. So while gold accumulates, silver dissipates. This creates a paradox. Silver is more abundant in nature, but less available in practice. Gold responds predictably, rising steadily. But silver reacts violently because silver markets are smaller and more easily influenced. This is the mechanism the Hunt brothers exploit. They begin accumulating physical silver in futures contracts, removing supply from the market. Prices didn't just rise, they spiral. By purchasing what exists today and what will exist tomorrow, they created an artificial scarcity. At this point, the market is no longer driven by industrial demand. It is driven by positioning, who owns what and how much. Gold resists this kind of manipulation. Its market is deeper and central banks act as anchors. Silver has no such anchor. When regulators intervene, raising margin requirements, the system collapses. Prices fall relentlessly. The Hunt brothers are forced to sell. What began as a bet on silver's potential ends as a demonstration of its structural fragility. This pattern repeats across financial history. The same logic drives modern bubbles, where scarcity narratives collide with speculative behavior. Silver's story is a blueprint. Modern investors face the same question: gold or silver? The answer depends on understanding what each asset actually represents. Do you want stability or do you want opportunity? Do you want protection or do you want potential? The answer depends not on the metals, but on the system you believe in. Systems can shift rapidly without warning. The 1980 collapse was a revelation. It showed that value is constructed. Gold didn't break because its role is anchored in collective belief. Understanding this architecture is the most valuable insight, because in the end, gold and silver aren't competing answers. They're different questions.